Hello everyone, Rahul here. So today we are going to deal with the second part of the last time what we had done. That is, the chapter is monetary management and financial intermediation. So in this chapter, what we are going to deal is about the bank credit as well as some other things about like capital adequacy ratio, etc. So this chapter is mainly data based, which is not very much important from the point of view of UPSC. So we are going to restrict ourselves mainly to the main terminologies used in this chapter, which can be important for pre as well as mains exam and can come very handy while writing your answers for the mains. So let's move ahead. Now, what do you mean by bank credit? Bank credit, obviously the loan provided by the banks to the customers. Now, bank credit is the important indicator of economic activity. Okay, the high growth observed in 2003 to 8. 2003 to 8 we observed very high growth in lending. Okay, so it was also followed by the rise in the monetary aggregates. Obviously money supply in the economy will increase, which was usually at the 20% mark year on year. Means every year it grew 20% over the last year's credit given. Okay, but in 2008 it was impacted by a global financial crisis, due to which the credit giving ability of banks or credit ratio decreased by 5% to 15%, that is growth decreased. This happened till 2010, and after February 2014 it has subsequently slowed down to around 10%. I will show you in the graph which I am showing you now. See here, we are showing graph from April 2011 to December 2015. So just see this February 2014. What you see here is approximately it is near 15%. But after that is falling, and it has fallen below 10% or approximately near 10%. Okay, so what factors are responsible for this fall? So the factors responsible are, first of all, it is incomplete transmission of the monetary policy, as banks have not passed on the entire benefit to borrowers. The second point economic survey says is unwillingness of banks to lend credit. Okay, because banks has already very high non-performing assets. Third one is worsening of corporate balance sheets, which is forcing them to put their investment decisions on hold. When they are not able to earn much profit due to reduced demand, how can they pay for the loans? And the next point is the more attractive interest rates from borrowers in the bond market. Means borrowers can buy at much less rate than the bank is giving them. Okay, so these are the factors responsible for the decline in the growth of the credit uptake. So let's move ahead. Now the economic survey talks about the non-food credit, but before that, what we need to understand about what do you mean by food credit and what do you mean by non-food credit. The credit or loan provided by the nationalized banks to the FCI, that is Food Corporation of India, is known as food credit. It is used for procurement of food grains by FCI and part of a gross bank credit. Now food credit is determined by external factors like how the monsoons have happened, what is the size of market surplus, how much government is going to procure. All these factors affect the non-food credit. Now, what is gross bank credit? Gross bank credit is the aggregate amount which the banking system is willing to provide to any individual or organization or customer. So the lending can be towards various sectors like priority lending sectors, and food sectors is one of these sectors. Hence, what do you mean by bank credit? Now, bank credit is equal to food credit plus non-food credit. Okay. So food credit one is FCI वाला, ठीक है. Non-food credit one is industries, services, etc., etc. So now what we see is what is written in the economic survey. The growth of credit have fallen for industries. The economic survey says that the personal loans are seeing the most growth in credit uptake, followed by agriculture and light sectors, followed by services and industry. Mind you, here we are talking about growth of credit. Note the absolute amount of credit. If you see the absolute amount, you will be surprised that the industry has the most of the amount as the credit uptake of the total pool from which banks give. To give you a crude example, suppose 100 crores banks can give. Maybe industry would be having 50 crores, but its growth of credit year on year is less. Okay. So, from this graph, you can easily observe the sector specific growth of non-food credit as I have just told you above. See here, the green line indicates the personal loans. So it has the highest growth, followed by agriculture and allied sectors, followed by services and then industry loans. Okay, so let's move ahead. Now, what do you mean by credit impulse? It is given in the box in economic survey. So credit impulse concept was given by the Michael Biggs, who is an economist in Deutsche Bank. So what do you mean by this? It is the new credit change issued as a percentage of the gross domestic product. Means how much more credit is being issued per GDP or divided by the GDP into 100. That is change in credit issued by GDP into 100. It will give you a percentage. So studies since 2008 have shown that investment growth is very closely correlated with credit impulse. It's kind of speed in the real life. That is, more is the credit given, more is the rise in the percentage or the credit impulse, more is the investment growth, because more money is being pumped in the industries and services and agriculture. Okay. So what do studies say? Studies says the credit impulse in comparison with other credit variables is better able to predict recoveries from a recession. Now, what do you mean by recession? Recession is generally contraction of the economy or negative growth rate which continues for 2-3 quarters at least. Okay. So the credit impulse is able to predict even the recession better than the other credit variables. So let's move ahead. Now we are going to see the comparative credit flow trends in BRICS economies. Now the first point is the bank credit growth has remained subdued in all of the BRICS economies, that is Brazil, Russia, India, South Africa, except China. Second point is, in case of Russia, the credit flow has seen a sharper decline, especially after the that embargoes as well as sanctions imposed by US-led group, and the Russia has been thrown out from the G8 also. So obviously the investment has decreased in Russia and hence the decline in the credit uptake. So this graph will show you clearly what I have told you above. See, this purple line is for China. It has remained stable. The credit given has remained stable. The India is at second number. It has zigzag pattern. First till June 13, the credit was falling, then it rose till June 14, and then it's again falling. Okay, so the worst performance is given by Russia, as shown by this green line here. Till June 15, it has the least real bank credit outstanding. So let's move ahead to the next slide. So interest rates of scheduled commercial banks excluding regional rural banks. Now scheduled commercial banks, see what do you mean by scheduled commercial banks? It is very important for the pre-exams too. Please see in the internet what do you mean by scheduled commercial banks. It is given in the, or it is defined in the RBI's Act of 1934. So you will know what do you mean by it. So please see to it. Now what does it say? You know, in response to the reduction in the policy repo rate by 125 basis points since January 2015, as I have already told you in the previous lectures on economic survey, scheduled commercial banks have reduced their median term deposit rate by 72 basis points and base rate by 60 basis points till December 2015. Now RBI is giving decrease in the policy repo rate of 125 basis point, that is 1.25 percentage, but banks are giving the reduction rate is 72 basis points or 0.27% in the deposit rate and 0.6% in the base rate. The base rate, the least interest rate which the banks charges to the most preferable customer. That is, the banks can't charge below this interest rate from any borrower. Okay. So RBI in its financial stability report of 2015 September has said that the full pass-through has not happened. That is, monetary transmission by banks to the customers have not happened due to structural rigidities in the credit market. Now, what are the key reasons for these structural rigidities? First of all is mobilization of deposits at fixed rates, with only 20% of term deposits getting repriced during the year. See, banks give you fixed deposits or RD at a fixed rate. Okay, after this much time or after 5 years you will get this much money, but banks don't see that how much money they are earning from lending. Okay, so they have the compulsion to pay at this interest rate after 5 years. So it is not market based. That is, it doesn't vary with the ebbs and flows of the market. So banks have to sometimes take a loss, due to which they are not passing the money or credit completely. That is, they are not passing the reduction in the policy rate completely. The next point is the competition from small saving schemes, where the interest rates have been revised with considerable lags. You would have heard the news that recently the interest rate on the small saving schemes have been reduced from 8.7 to 8.2%, I think, in case of PPF. So this was a good move by the government, so that it increases the competitiveness of banks with these small saving schemes. Now the third point is the saving deposit rates of public sector banks have remained unchanged at 4% despite its regulation in October 2011. The same thing I told you in the first point, that these are not varying according to the variation of the market or the market model of the banks. That is how much they are earning. They are not passing on to the customers. They are giving them fixed rate of interest. The next point is the base rate of banks being mostly determined on the basis of average cost rather than the marginal cost. Now, what do you mean by this marginal cost than the average cost? Now, marginal cost of funds based lending rate, it refers to that money raised by banks in the last month or quarter before the lending rate review. What do you mean by is that? First of all, the banks, if they were taking the average cost, it will take all the loans given by the bank and then it will find the lowest rate. Okay, but marginal cost, if the bank gives the money at marginal cost, what it will do is it will check the previous month's lending rates, last 1 month or last quarter or last 3 months lending rate. So it will give the real time status of ability of banks to give that much low lending rate. So it will be very much beneficial for banks as it will show the real time profit or ability of banks to compensate for the losses accrued due to the low interest rate given to the person which is getting the money at the base rate. To cut short the matter, that the money which is given should be given seeing the past 3 months performance of banks. Okay, so let's move ahead. Now if you want to read more about this marginal cost, a very good article had come in the Economic Times a few months back. You can see the heading of the article is the Will RBI's new base rate guidelines help borrowers? You can find out more information in this article. So let's move ahead. Coming to the performance of scheduled commercial banks. Now during 2015-16, the performance of these banks have remained subdued. Why it has remained subdued? First of all, there is very less growth in loans and advances. It is below 10%. Secondly, the growth in investment is also slowed down marginally. So obviously when growth in investment has slowed down, they will take less loan. The third one is poor earnings growth reported by the corporate sector. When the corporate sector is not earning enough, why it would like to expand and why would it like to take loans? The fourth one is the risk aversion on the part of banks due to rising non-performing assets, which is the major problem which the state banks are facing or public sector banks are facing. Now alternative sources, corporate sector companies are shifting to other sources of borrowing. First of all, the main source is external commercial borrowings for which the limit has been raised by RBI from time to time. Second one is corporate bonds, which they issue in the public and hence they can raise money. And third one is the commercial papers, which the blue chip companies, which has very good reputation in the market, give float in the market. So coming to the capital adequacy ratio. Now this is very important. It is coming time and again in the newspapers that the Indian public sector as well as private banks have to follow the capital adequacy ratio as defined in the Basel III norms. Okay. Now, what do you mean by capital adequacy ratio? Capital adequacy ratio is the ratio of bank's capital in relation to its risk-weighted assets. Capital adequacy ratio CAR is equal to, first of all, bank's capital in numerator upon risk-weighted assets of bank. Okay. So the basic approach of capital adequacy framework was that a bank should have sufficient capital or money, to say it crudely, to provide a stable source to absorb any losses arising from the risks in the business. Okay. Now it is decided by central banks and banks regulators to prevent commercial banks from taking excess leverage and becoming insolvent in this process, because the banks in the absence of regulators can prove to be reckless in giving loans, which can lead to defaults and hence closing down of banks, which the regulators don't want, or which the government as well as people don't want. So, to explain little more, the bank's capital comprises of tier 1 and tier 2 assets. The tier 1 capital asset consists mainly of shares as well as disclosed reserves that a banks have. It is of the highest quality because it is fully available to cover the losses, whatever loss happens to the banks. Suppose the loans are not getting paid. So after this tier 1 capital, which is of highest quality, we have tier 2 capital, which consists of certain other reserves and certain types of subordinate debt. Now I will tell you about this little later. First of all, the loss absorption capacity of tier 2 capital, which I have just told you that it consists of certain reserves and subordinate debt, is lower than that of tier 1 capital because it is of low quality. Now what do you mean by this subordinate debt? The subordinate debt is a loan that ranks below other loans with regards to claims on assets or earnings. I will give you an example. Suppose if a bank goes insolvent, so whatever assets it will have, first of all it will be taken by tax authorities, okay, as well as the large lenders or large persons who have invested money here. Then it will given to subordinated debt people, and then it will given to the shareholders. Okay, so this is the highest quality, this is the second rung quality, or which may or may not be paid. Okay, now the risk weighted assets, what does it take into account? It takes into account the credit risk as well as market risk faced by the banks. Now credit risk is the credit which is not coming back due to defaults. Market risk refers to the risk to a bank resulting from movements in market prices, in particular changing in the interest rate, foreign exchange rates, as well as equity and commodity prices. Okay, now the Basel III norms stipulates that this CAR ratio should be 8%. That is, banks should have capital at least 8% of its risk weighted assets. Okay, whatever capital it has given in the form of loans as well as market risk, that is risk covering the change in the rates and the exchange rates as well as commodity as well as share prices. Okay, now as per RBI norms, Indian scheduled commercial banks are required to maintain the capital adequacy ratio of 9%. Basel III norms have 8%, but RBI says maintain 9%. While Indian public sector banks are emphasized to maintain credit adequacy ratio of 12%. RBI has said 9%, but in that too, because we have various varieties of banks, the Indian public sector banks should have the CAR of 12%. Now during 2014-15, what has happened in the capital to risk weighted assets ratio, or CAR, that I am telling you, of scheduled commercial banks has remained well above this 9% limit decided by the RBI. Now it was before 13%, but now it has come down to 12.7%, which shows that the ability or the assets or capital of banks have been decreases as compared to risk with the banks. Okay, now given the deterioration of the asset quality and gradual implementation of Basel III, banks will have to improve their capital positions to meet unforeseen losses in the future. The estimated capital requirement for the next 4 years till the financial year 2018-19 is 1.8 lakh crores. Now this is a very huge amount. Now banks are the government is going to put 70,000 crores from the budgets. Not only this year's budget but the subsequent budgets also. This year the government has thought to inject 25,000 crores into the banking system, and it will keep doing it in the future as well. Now, first of all, before coming to the next point, I would like to tell you something about the stressed assets. What do you mean by stressed assets? Stressed assets is non-performing assets as well as restructured assets. I will just tell you. See here. The space is not here, so I am writing at the top. Stressed assets is NPAs plus restructured loans. Now NPAs, what do you mean by NPAs? NPAs are those for which the interest has not been paid for 90 days. Now the asset quality of scheduled commercial banks have come under stress in recent times as the gross non-performing advances or gross non-performing assets have decreased to 4.6%, increased to 5.1% from 4.6%. I will just tell you what do you mean by that. What I am telling you is that previously the total credit a bank gives is suppose 100. Previously NPAs, gross NPAs I am talking about. I will explain you what do you mean by gross and net. Gross NPAs was 4.6% or 4.6 rupees out of 100 rupees. But now it has increased to 5.1 rupees out of 100 rupees. So this means that the non-performing loans have increased, which is leading to losses of banks. Okay. Now the second point I want to tell you is that a restructured standard advances as the proportion of gross credit given has also declined to 6.2% from 6.4%. Now what do you mean by restructured advances? Restructured advances are those which has been modified, like suppose a person had to give a loan in 5 years. It has been made to 10 years and divided into many installments so that the burden on that borrowers is less. So this restructuring has decreased from 6.4 to 6.2% in the same period, while the stressed advances to the total gross advances ratio, that is how much money the bank has given to borrowers is stressed, has increased to 11.3% from 11.1%. And the crux of the matter is that the money which was previously structured has been converted into non-performing assets. Okay. So obviously when the restructured loans have been declared as non-performing, the restructured loans will decrease and non-performing assets will increase. Okay. Now I have already told you that NPAs on which the interest is not paid for 90 days turns into NPA. And for this the RBI had decided the guideline that the banks needs to set aside money to cover the 25% of the loan amount in the first year. That is beforehand. That is before giving money to the borrower, banks have to keep 1/4 of the money aside so that it can cover the losses. Suppose 1 crore is lent to a person, So the banks have to keep how much money? 25 lakhs in a separate account, so that if a borrower is not going to pay, the banks can take the money from there. So the net non-performing advances as a proportion of total net advances for all the SCBs have increased to 2.8% from 2.5%. Net NPAs have increased. Okay. Now, what do you mean by gross NPAs and net NPAs? Gross NPAs is the total number of NPAs of the bank. Simply we add the total number of NPAs. Sorry for this barking of dogs. I hope you don't mind. Now, gross NPA is total number of NPAs of the banks. That is when we sum 10. So suppose bank has given loans to 100 persons. Out of that, 10 persons are not giving money for 90 days. So the banks declare that as NPA. So sum of the NPAs of 10 persons becomes gross NPA. Now banks would continually assess this by evaluating their loan payments and decide their NPAs. What we need to understand here is that the NPA occurs, it is not just an interest income loss to the bank, but a principal loss as well. Suppose a bank has lent 1000 crores to a company with an outstanding loan of 600 crores. Suppose to Malya they have given. So then the bank would lose those 600 crores as well as the interest which would have come on those 600 crores. Okay. Now this is a serious loss to the bank and someone has to bear that loss. If the loss is much higher, and there is every possibility that the customer's deposit may get eroded. So this is where the regulators come into the picture. Knowing that the banks would take extra risk in giving the loans as they have to earn profits, the regulators decided to put a condition known as provisioning. I've just told you that 25% of the loan given they have to keep. Okay, so this is called provisioning. Now to elaborate, banks need to continually assess their loans and set aside the amount in the beginning itself to accommodate for any losses. Okay. So what do you mean by net non-performing assets now? Net non-performing assets is simply the total bad assets or total non-performing assets minus the provisioning that the bank has done. 25% provisioning a bank has done. Just I gave you the example of 1 crore. Out of 1 crore, 25 lakh bank has set aside. So net NPA is 75 lakh. Actually not 75 lakh. I will explain you little bit here. Gross NPAs is equal to net NPAs plus net NPAs is equal to gross NPA minus provisioning. Provisioning is 25% suppose. Now out of the total money given by the bank, some money would have been returned by the borrower. So out of the left money, if we subtract the provisioning amount, then we arrive at net non-performing assets. Okay. So now coming to the next point of PJ Nayak committee and Indradhanush scheme. Now the mota moti what they say is that both they say that first of all the government stranglehold on the public sector banks have to be reduced, because government dictates the banks to give loans to the businessmen which are of dubious authenticity. So banks later have to face the NPAs. The other point the Indradhanush scheme says is that the position of MD should be separated from the position of chairman. The appointment of the senior position in the banks have to be by bank board bureau, in which the government's interference should be very less, and now there should be transparency and accountability. Transparency, that is the proactive information giving by the banks, digitization of the banking infrastructure. Okay. Now also the Indradhanush scheme says about the capitalization of banks that I have recently told you in the previous point of 1.8 lakh crores. These all points are mentioned in the Indradhanush scheme as well as PJ Nayak committee recommendations. So now coming to the next point. Now the contribution of 5 subsectors, namely mining, iron and steel, textiles, infrastructure and aviation, have contributed most of the bad loans or stressed advances. Okay, and out of that, aviation and infra loans are a cause of concern. Why? The stressed advances in the aviation sector has increased to 61% from the 58.9% in March 15 to the end 2015. 61%. That is, out of the total loan taken by the aviation sector, 61% is stressed. Similarly, in infrastructure, it has increased to 24% from 22.9%. So these both are a cause of concern. So thank you everyone for listening to this lecture. Please like, comment and subscribe to www.decipherize.com, and please like our Facebook page. Thank you.